Hi, Sophia, you there?
Hello. Yes.
I think you might need to delete that second message because the link is, when I click on that, it doesn't look right.
What do you mean?
Okay, it looks fine now.
Oh, oof. Okay.
Yeah, it was showing like something from my YouTube channel, I think. So it's just like it didn't look like the right thing.
Maybe. Okay. Maybe it was just because it wasn't open,
Yeah.
but it now is. Okay. Yeah. So this one is fine. Zoom is open. Just waiting for people now. Pause is live.
I think generally you want to channel people to the live session so that it auto plays to the next one rather than putting them into the actual session. Do you know what I mean?
Yeah. Okay. Let me change it.
I would maybe get rid of that one anyway.
I will do it again with the live thing.
Cool. Well, it's playing. We're up and running.
Yeah.
I don't know where my phone is. I need to find my phone.
Okay.
See you in a bit.
Cool. Mm-mm.
Hello, everyone. Welcome to the Resilience Center. Where he is.
Okay. I'm just
All
gonna
right,
give.
we're up and running.
Yes. I'm just gonna give everyone like a few minutes and then I'm gonna send an email if they haven't joined. Hello, how are you?
Hi, Julian. How's it going?
Hi, Anthony. I'm very well. No, I'm not on mute. That's always a good sign.
Good start. Yeah, you've got your slick Munich Re background. I like that.
Is that on my kitchen?
Hi, Antoine. Hi, Michelle.
Hi, Aunt Sophia.
Hello, how are you?
Hi, Michelle. You're on mute at the moment, it seems.
There we go.
There we go. Okay, well, we've got 3 out of the 4 with no technical issues, so that's a promising start. As you can see, Michelle, I am the slide, but I will not. My face will not be appearing when you want the slide to come up.
Okay. I was just going to try and change my background. Let me try
and. Hi, Michael.
Hi, everyone.
Hello.
Well, you're a very prompt panel. I'm impressed.
Very compliant people, aren't we?
Compliant, yeah. I'm sorry that I left the calendar placeholder for like 3.5 hours. I thought I'd updated that a while back, so apologies. It may mean you have a slightly more relaxed afternoon after doing this panel as a byproduct of that.
Actually, Anthony, I have bad news. I don't, because I was expecting that was reflective of the originally allotted start time, realizing there was this 1 hour difference between UK and Europe. So the latest I can do is probably 3:05, 3:10 my time. So, 55 minutes or so from now, and then I unfortunately have to dash out. I can try to connect from a mobile, but I'll need to see what I can do.
That's a slight curveball. So let's think about where you're being brought into this discussion.
I mean, I can frame it so that we make sure that Michael's topic is covered earlier on.
Sounds like, yeah, that'd be the best way to do it. Feel free to throw me under the bus and explain that my terrible diary is why you're losing a panelist halfway through. So we've got you till about 2:05. Okay, so you should be in the first sort of 40 minutes of it then. Okay,
that would be really appreciated. Apologies for the hassle.
But we were expecting it to be 45 minutes and then Q&A anyway, so I think that should be okay.
True. Yeah. Okay, brilliant. So Michelle, in terms of when you want this slide brought up, this is right near the beginning, I assume, is it?
Yeah, so I'll introduce myself and the panelists, and then I'll just say, really set the scene for literally just a couple of minutes. So I'll reference, whether it's you or Sophia, who would be the best person to reference just to bring that slide up.
Well, it's going to be me. Basically, okay. I'm going to be off camera, and then I'll just put myself on camera, and all you'll see is the slide. So.
Okay, perfect. Okay, so I'll just reference to you then when to put the slide up, and then we can take it down when we then go into the panel discussion.
Okay, perfect. All right. Well, I've got a few bits and bobs that I need to type, so I'll just leave you with Sophia. But I mean, generally, it looks like we've got no issues. So I think normally we just say you can kind of potter on emails or whatever you need to do while you're sat on the call. Yeah, and I'll return in time to get that slide up. So
okay, fantastic.
Did anyone have any questions at this point?
And are there any questions which aren't in the email that Anne sent across that you would like asking, just to be able to talk a bit more about your specific areas?
Is anyone going to mention COP and the loss and damage focus in COP that's coming up?
No, I don't think it would naturally fall with any of the questions, so I can definitely either ask you a specific question on that, Julian, or if you want to bring it into something that you're already planning to talk about.
I mean, loss and damage and resilience and insurance is very much relevant,
Yeah, gonna be
right?
the theme of the absolutely. But yeah,
So, go
would
ahead.
you like a specific question on it, or were you planning to cover it? Because one of the questions I'm asking you is obviously about the challenges which the industry is facing. So I'm not sure if you would, within that sort of framework of that question, you would think of bringing that into your response.
No, maybe it's just worth asking about COP as a specific question. Just say, are there any expectations for COP today?
Okay.
And the two key things that I'll be looking for are related to Article 6 and loss and damage,
Yeah.
is very much relevant. So don't need to labour it particularly, but since it's bearing down on us, it's probably worth mentioning.
Yeah.
Okay, well, I will leave you guys. I'll come back, but best of luck. Sophia is highly capable. You're in very safe hands, so she will look after you, and if you need me, she can get hold of me. So I'll see you shortly. Best of luck with it.
Thanks.
Thank you.
Yeah, so it's quite straightforward. So obviously this is just on Zoom. Everything will be live streamed into Swapcard, but all you will see is basically the Zoom setup. I will be using the chat to communicate with you, so we can just do that now. But on the right-hand side, you should see the chat. If there's any questions that come through Swapcard, I will also just paste them here, so you can see them. But also, if you want to communicate with me throughout the course of the session, feel free to just use the chat. It's just an internal chat. There is a 10 seconds lag. So I will let you know when to start. I will obviously go off camera and mute myself. And then at the end as well, to make it easy, I will just give you a 5 minutes warning and then probably a 2 minutes warning. So then you don't get cut off from the panel. But yeah, do you have any questions about anything?
That's great. Thank you.
Oh, so I think it starts at 1:25. So we can maybe just come back at 1:20, 21.
Sure. I'll go on mute and switch my camera off. I'll read. Thanks.
Maybe a quick question, if you don't mind, Sophia, Michelle. So you intend to go through the sort of list of talking points that Anthony shared earlier this week, right?
Yes.
And that's the bulk of the discussion, right? The 30 minutes is indeed how much time we have for the primary talking point.
Yeah, I mean, I'd say, looking at the timing, we've got, say, 45 minutes of discussion, or for you three of you to have 45 minutes. So if you think, then you probably got 2 substantive questions each. So you're talking about sort of 5-6 minute responses, really, aren't you? And in terms of that sort of, and then obviously ability, I mean, do feel free to make it a discussion. I think it's a lot more interesting to have a discussion. So if one of the other panelists raises something in their responses that you would like to comment on, please feel free to do that. I'll keep an eye on time, and I'll keep an eye on where we are in terms of the questions that Ant sent across, so that I can try and make sure we kind of get through everything, mindful that obviously we want to leave time for questions at the end.
Yeah.
Sophia, if you wouldn't mind flagging after, because I'm going to reference the beginning about asking questions, if you wouldn't mind flagging if no questions are coming through at some point, because it might be that we can continue discussion a bit longer if there aren't any questions, or I might halfway through just give a reminder to people to ask questions. But it'd be a shame to cut the kind of discussion short and then actually find that there aren't any sort of audience questions. So that would just be useful to have an update on that if possible, and just to send the questions through when they come in, so that we get a sense of where the interest is from those who've dialed in.
No, totally. I can do that.
Thanks.
And Michelle, how do you want to handle the 5-10 minutes slot on big picture? Because you said it has all. Are we all supposed to contribute to that part right after your intro?
No, I don't think so. I think my plan is to introduce you all, to do the kind of housekeeping part, give a very brief introduction, really, because I have no idea as to the level of knowledge base of people on the call, whether it's, you know, university students who are finding out this topic for the first time, or whether it's people in the industry who are sort of live this day in, day out. So it's very much a kind of starter for 5 introduction about the climate challenge, why we're having these discussions, the sort of balance between mitigation, adaptation, resilience. And then Antoine, I'll come straight to you really, hopefully, to provide a little bit more sort of detail from your experience as well.
Understood. Thank you.
But do feel free to message, you know, in the chat anything you want me to raise or questions you want me to ask during the session.
Great.
Perfect. I think we can just go off camera if you don't have any other questions. Mute ourselves and then come back in a couple of minutes.
Fantastic. Thanks, Sphere.
Thank you.
Doesn't work my end. Does it work your end, Michelle?
No.
So you click the button and nothing happens?
Yeah, I click stop video, nothing happens.
Interesting.
I don't want to mess around with my video settings too much.
I could try stopping.
Don't worry, it's fine. I'll leave my video on and just carry on as I was. Thank you.
Okay, if everyone can please come back.
I managed to work out how to change my backdrop. Productive 10 minutes.
There is a very little dog, so I was actually thinking that you could start at 25, that I will let you know in the chat when to go live.
Okay.
I don't think you need to start. I would usually ask you to start a minute before, but the lag is really minimum.
Okay.
Okay, perfect. I will just mute myself now, but I will let you know in the chat when to go live. We can't hear you, Michelle, now? No.
Can you hear me?
Yes, okay.
Perfect.
Perfect, thank you.
Good afternoon, everybody, and welcome to this virtual panel, which has been hosted by the Better Insurance Network. My name is Michelle Radcliffe, and whilst an insurance and environmental lawyer by background, I now work as a director within the insurance consulting and technology team at WCW with a specific focus on climate and broader ESG and sustainability initiatives. Now, I'm delighted to be hosting today's panel, which is entitled Business as Usual, Building Resilience and Adaptation into Underwriting. And I'm fortunate to have a fantastic panel of speakers with real industry knowledge on the challenges and opportunities which are now facing the insurance market. Now, today we'll be very much focusing on the physical impacts of climate change. So I'm joined by a great panel. We've got Antoine, who's now working at Gallagher Re. He's Global Head of Public Sector, Parametric and Climate Resilience Solutions, but also has experience working for the World Bank as well, most recently working as a Senior Climate and Disaster Risk Finance Specialist. I'm also joined by Julian Richardson, who has considerable experience in this area. He founded Parhelion 17 years ago, which, for those of you who don't know, is a boutique insurance and risk finance business focusing particularly on carbon markets, climate change risk, and renewable energy investments. He's now acting as Chief Underwriting Officer also for Munich Re Specialty Group's Green Solutions business. And finally, Michael Tsonyi, who has been with Zurich now for over 17 years. He's now acting as Zurich's Flood Resilience Program Lead, but has been very instrumental in developing Zurich's public policy on flood insurability and climate change adaptation. Now, unfortunately, Michael will only be with us for the first 40 minutes of today's session. So we'll try and make sure, Michael, that you're sort of covering some of your key areas early on. So I'll start the session today by giving a very brief introduction to the topic, and I'll then turn over to the panelists to go into more detail and have more of a discussion. So this is an hour session, but we'll aim to leave 10 to 15 minutes at the end for questions. So please do submit any questions that you have through the link in the screen, and we'll address those at the end. All the speakers today are on LinkedIn, so equally, if you have any questions you would like to raise with them directly, please do reach out. So as a starting point on this topic, and I apologize in advance for perhaps seeming slightly doom and gloom, but I think for any session where we're talking about resilience and adaptation as a result of the physical impacts of climate change, we have to ultimately acknowledge that climate change is a reality. You know, we see in the press daily references to extreme weather events, droughts, floods, hurricanes, storms, and the continuing increase in the frequency and severity of such events, which are really placing significant stress on societies and natural systems. Now, I'm just going to flash up a slide, just one slide from us today, briefly, which I just think is really helpful to put this into context. This is a slide which a colleague of mine put together, the climate challenge slide, as we refer to it. And I think it really succinctly demonstrates the challenges which we're facing, really those temperature challenges and what that means and what the impacts of that temperature change is in reality. Now, the focus on this slide is very much on that 1.5 degrees threshold, the threshold that was in the Paris Agreement, where countries who signed up to that agreement were seeking to minimize the damage of the climate crisis. It's also the threshold which is considered by climate scientists to be a key tipping point for the planet, beyond which the chances of extreme heat, flood, drought, wildfires, and therefore things like food, water shortages will become more commonplace. Now, with that temperature increase comes a risk in the physical impacts of climate change, but climate hazards leads to all sorts of different consequences, which we will probably talk about today, including water scarcity, crop failures, loss of infrastructure, and actually what the knock-on effects are for that in terms of sort of the markets, financial markets, conflicts, human migration. But there's also the bigger question here about what does this mean for insurance? Now, extreme weather and climate events have significant macroeconomic implications. They impact financial stability. They can weaken the financial position of governments when they're required to step in and provide relief or cover following losses after a catastrophe. But it's not just governments who are impacted. I know Julian will certainly be able to tell us some stories about conversations that he's had with governments, but we also start looking at affordability and insurability of natural catastrophe risk is increasingly becoming a concern. Now, in Europe, historically, only a quarter of total losses caused by extreme weather and climate-related events across Europe were insured. In other parts of the world, that figure is a lot less. And obviously, this brings with it the question of the insurance protection gap, which is a big concern and often debated. There are headlines in the news today, in fact, talking about some of the players in the market thinking that the insurance industry needs to do more, to be more aggressive in absorbing the bigger risks from areas such as natural catastrophes. Others looking more to what the insurance industry should be doing in terms of private and public partnerships. So the point is that we're referring to adaptation and resilience in insurance more and more. Now, we'll come on to talk about what we mean by that. But in summary, adaptation, I think the IPC puts it best when they talk about adaptation as being the adjustment to actual or expected climate and its effect. Whereas resilience, I think, again, there's an interesting paper written by the Grantham Institute, LSE, which talks about resilience as that capacity to prepare for, to respond to, and recover from the impacts of hazardous climatic events, whilst incurring minimal damage to society well-being, the economy, and the environment. So our focus today is very much going to be on adaptation and resilience, but I'm sure we'll also have discussions about how that actually sits also with the challenges of the mitigation, the need to mitigate the climate impacts. So I'll turn to the panelists now, and I think we can take down that slide. But Antoine, turning to you first, I mean, you have fantastic expertise in the insurance market, and as your experience with the World Bank. I've touched very briefly then on some of the outline really for the basis of this session, but I'd love to hear more from you about what you see as the main issues within resilience and adaptation within the insurance market and what those challenges are presenting to us at the moment.
Thank you, Michelle. Well, you nicely set the scene already. I'll try and be very specific and talk about some examples. And first, maybe I want to go back to adaptation versus resilience, because I think this is still sort of poorly understood as a sort of joint concept. Indeed, adaptation would refer to the capacity of, let's say, governments, societies, businesses to adjust to, let's say, current or future risk environments. So that includes specifically risk reduction investments, for instance, and more globally, let's say, transformational shifts of economies, livelihoods towards more sustainable, let's say, ways of operating. So in terms of natural catastrophe risk, for instance, that means building flood defenses such as dikes, whilst keeping in mind that whatever we do on the adaptation can have positive or negative sometimes effects on resilience. And I'll go back to my example of the flood dikes in a minute. Resilience would be any sort of measure, policy, instrument that looks at the ability to cope with sort of events once they materialize. So that's typically the role of insurance, but it's also the role of, let's say, contingency plans in general. So going back to my example of flood dikes, actually building dikes may have a negative effect on resilience in the sense that it might not incentivize the use of insurance. And so when those extreme events do happen, and for instance, the dikes can be poorly designed or poorly maintained, you could have, the expectation that you do not need insurance, whereas in reality, you actually need a combination of both adaptation and resilience. So I was just using this sort of counterintuitive example to say that the relationship is not straightforward. It's not necessarily the more the better. And going back to your question, Michelle, I think we need a lot more, let's say, holistic approach to adaptation and resilience collectively, combined. So that example that I mentioned is quite telling. But the issue also, I think, is to be found in the way decision makers and governance schemes are structured. Typically, adaptation is in the hands of, let's say, ministries of equipment, ministries of agriculture, ministries of interior, all of those sort of key public decision makers that look at slow onset and sort of forward-looking risks or investments. Whereas typically resilience is in the hands of the insurance industry, insurance regulator, but essentially the Ministry of Finance. So you have a gap clearly between these different ministries and stakeholders and decision makers. So that's one element worth pointing out. But also there's a lack of, I think, understanding and analytics that can really connect the two different dimensions of effective risk management to a large extent. You're looking on the one hand at sort of long-term investments, and as I said, cross-sectoral with direct and indirect impact on the economy, adaptation. And on the other hand, you're looking at typically an industry that's been looking at NatCat models, which do sort of cover geographic impact really well, but the time dimension much less so. And you really need to combine the geographic view on risk and impact with the time dimension. I talked about the transmission channels and sort of the bigger picture in terms of losses from a direct and indirect economic, financial, fiscal, and also human impact perspective. So long story short, I think the insurance industry has a key role to play on connecting the two agendas, but there's a long way to go. Just to finish off, I'll use the example of agriculture. I think it's important to understand that there's a lot going on already. In terms of agriculture, adaptation measures would be typically things like drought-resistant crops or investments into irrigated agriculture or climate-smart agriculture. The resilience sort of measures and investments would be parametric insurance, cash transfer, social protection programs. So you really try to connect these two agendas. In the case of agriculture, it's already happening to a large extent, but clearly there's more that can be done.
Thank you. It's really interesting. And Julian, I'd love to pick up with you there because I know, were just talking then about some of the projects, and I think be really interesting to hear your thoughts on, from your experience, because you've been in this area for such a long period of time, and you've really seen the market and the industry develop from, I guess, when you started out, something that was quite unusual, I imagine, to be talking about in conversations. And you can see through your own career journey, this has now become commonplace, and teams are being set up to do what you've been doing for a number of years. So I'd really be interested to know about really your what your thoughts are, given that journey and the sort of lessons learned, but actually given where we are now, what advice and thoughts you have about the challenges and how you see those being overcome.
Yeah, thanks, Michelle. Yes, I have been doing this for a little while, it has to be said, but we are making significant progress. I think it was really important that you picked up on that Grantham Institute definition around what do we mean by resilience, because that is often something that's not really thought about as, resilience. It's thrown around as a word, but it really is about that ability to bounce back from an event. And, we know that the genie is already out of the bottle in climate change. In the US alone in 2023, we've had over 5,000 heat and rainfall records broken. And around the world this year, we've had over 10,000 heat and rainfall records broken. So climate change is here, and it's real, and it's happening. And we can't stop it. We can, use engineering and science to sort of mitigate some of those things. Antoine talks about drought-resistant crops. We can build bigger seawalls and so on. But it would be somewhat hubristic of us to think that we can stop climate change. So it is about our ability to bounce back from these events when they do happen. And fundamentally, insurance is what resilience finance is. And we've been bringing resilience to individuals and also to corporates for many years. That's essentially what our industry does. But we need to expand that through different ways and innovative schemes and approaches to make sure more people benefit from insurance or insurance-like solutions. Because I say insurance-like because it's not always appropriate to characterize it as insurance, but similar types of mechanisms. The Bank of International Settlements did an interesting sort of comparative study. Now, this is not climate related, it was earthquake related, but the point it illustrates is still effective. And it looked at the earthquake events that took place in Christchurch and in Haiti, which were sort of similar scale of earthquake events. And it then looked at the community and the economy's ability to sort of deal with those shocks. Now, I oversimplify it for effect and for brevity, but if you think about when a hurricane event happens in, let's say, Florida, once you've got over the sort of initial trauma and the loss of life and the emotional elements, people are able to come back to their houses, and they do a couple of things. They call the contractor to get their house repaired or rebuilt. They call the insurance company to pay for that rebuild cost. And because their houses are being rebuilt and they're getting the insurance payout for it, they're able to go back to work, and the economy sort of keeps ticking along. And of course, the economy gets an injection of capital from the insurance payout. If you're in an economy or part of the world where you don't have that insurance penetration, if you are in Haiti as opposed to Christchurch, you don't have the ability to call the contractor because you probably can't afford it. You can't afford it because you may not have the insurance payout. That means you're rebuilding your own property. That means you don't go to work. So that reduces the economy. And the economy doesn't get that injection of capital from the insurance payout. So you can see very clearly there's totally different impact from what may be a similar event to economies where there is good levels of insurance penetration as to where there aren't. And so that concept, we need to be bolder about it demonstrating the value of insurance and expanding the insurance coverage through these different mechanisms, because resilience finance is what insurance is, and that's our industry. And the more people we are able to protect, those communities we are able to support, the better chance they are going to have of long-term sustainable development.
Yeah, it's really interesting. And I'll just pick up on what you just said at the end there about, the word protect. And I think, we do talk about protect, but we are increasingly talking about the insurance protection gap as well. And I think, we can come on to this later, but, Michael, turning to you, your focus is very much on flood and flood risk. And we know that flood affects people globally more than any other type of natural hazard and causes some of the largest economic, social, and humanitarian losses. Flood is on the increase. We obviously want to protect people, as Julian said, from these risks. But how do we go about doing that from the insurance market when obviously they are ultimately answerable to numerous stakeholders? Profit is on people's minds. You're seeing increasingly amount of insurers stepping back from writing certain property business, for example, because of the increase in acute and chronic hazards. From your experience and the work that you've been doing on flood risk, how do you sort of balance this out? How do you look at these challenges? How do you avoid essentially pricing people out the market whilst providing the protection, which I think we agree is needed?
No, that's precisely the right challenge that we see at hand here, Michelle. And I think you framed it nicely originally when you said there is a fairly large protection gap, and even in the better developed markets for natural hazards and floods particularly, the penetration is relatively low. And I think that's something that we need to change, and we really need to look at our core business model. So as I hopefully take you through a little bit of a insurance, business value journey, starting with the claims process, I want to highlight the opportunities that we have to maybe modify, if not revolutionize, the market a little bit and participate more on that adaptation and protection piece. And as we were preparing for the panel, I was trying to listen into Echo Shui's keynote address, and she said that insurance is not charity, right? There is an underlying business model, and I precisely want to make sure that that business model can stay with us. And there's a challenge in the time horizons, in the sense that things that we do now are investments and often seen as costs, but the benefits kind of come asymmetrically only in the future. And that's also a challenge that we need to break through when we talk in terms of the different stakeholders that we have to satisfy. In the short term, we need to be profitable, but we need to make sure that long term we can still insure. And there's also a very interesting statistic from the Swiss Re Institute saying that the traditional insurance capacity in the natural hazard space is declining year on year, and just last year has been reduced up to a quarter. So I think that should send an alarm signal that we really need to work here. So how can we, in the traditional business model, then participate more strongly to incentivize adaptation, to essentially give clients credits when they do prevent and take protection seriously? So first of all, I think risk management and protection is in the DNA of the insurance industry. It is the core business. So if we really believe in the value of prevention, and by the way, our own studies show that, every dollar invested in prevention and resilience building on average saves $5 in future losses. So I mean, the cost benefit case, the economic case is really, really clear. So how do we participate more strongly in this ourselves? So let's almost start from the back end when the loss has happened. So with the claims process, making sure that we use the claims process, and whenever we touch a risk, whenever something actually needs to be fixed, that we bring adaptation and resilience into that process. So that's the key word of resilient recovery or build back better. And I think precisely in the UK, you have great examples with the flood re-scheme and with the government-backed incentives, where customers can build back better and can invest in resilience measures as the loss has happened, to at least make sure the same loss doesn't happen again, because you're improving the risk as you're remediating the loss. But I think that's only the starting point, because we want to avoid the loss from happening in the first place. So as we go through the value chain, let's look at risk engineering next, essentially the services that the insurance industry can provide to customers to better understand and then act on the risk and build in resilience and adaptation measures. Now, that is a service that's definitely increasing massively across the industry. I mean, we ourselves have built up climate resilient services quite strongly, and obviously peers are doing this as well. So there's definitely a supply out here to make sure that the insurance industry uses the skill set that we have and provides that to customers to advise them and support them in becoming more resilient. I think the trick there is we cannot just be a service provider as an insurance industry going forward in the climate space. If we only provide services but don't in-house the risk anymore, I think then we really, changing the business model not for the good. So how do we avoid just being a service provider? And I think that means moving over to the underwriting side and really ask the question, how can we incentivize risk reduction and adaptation more in our standard procedures? And how do we make sure that we are, bold enough and still take risks and not essentially slowly reduce market capacity and penetration to the extent where I think, and I've said that at COP last year, where there is a real risk of the core business model turning into irrelevance for climate risk. And we see this exiting markets, exiting hazards. I mean, floods in Australia have been a very big topic recently. We see it with wildfires in the US. So we really need to tackle this. And I think we need to look at the core principles and the value that risk reduction brings and directly bring this into the underwriting process. What credits can we give customers that better protect themselves? There is a question of how do we certify and how do we standardize adaptation measures so they actually are visible in our underwriting process? Are they included in our insurance models? And then thinking a step further, can we really participate in this cost-benefit idea of one saves five in the sense of making money, making investments available on our end, and co-finance or co-support these adaptation measures together with the customers? Because eventually, and I think it's one of the value propositions really underestimated that the insurance industry brings, the biggest value is not having the loss in the first place, and that is a value both for the customer. Yes, they're financially insured, but having a loss is still, a big problem in terms of business interruption, in terms of publicity, in terms of advising their clients that things will not be produced. So they benefit from not having the loss, and obviously we also benefit financially from not having the loss. So I think there are some of these ideas and opportunities that we just need to bring through a standard operating procedure almost, and really find out how we can incentivize how customers prevent better.
Yeah, that's very sensible. And I think, Antoine, just, picking up on that, you mentioned earlier on about, the flood dikes. I mean, just on that topic of incentivizing customers, when you have those types of schemes in place and the like, if you're looking at pricing, for example, do you take those factors into consideration at a customer stage? So that resilience, that building a resilience into the customer base, it sounds like, Michael, on the flood side of things, that would become a relevant factor. Is that fair to say? Do you look at these aspects? Julian, do you have any comments? Just in terms of, taking some of what we're talking about, and then actually, what does that then mean? Thinking back to the underwriting perspective, how do the underwriters then use these resilience tools essentially when they start looking at an assessment of risk?
Yeah, when you're underwriting any policy, you are looking at a whole range of factors. The point Michael made about giving sort of price credits or whatever for specific factors, that is really difficult for underwriters, because you are really pricing a basket of risks that may or may not occur, and to sort of try and carve out very specific premium elements, it can be really difficult. So those price signals are tough to give. But what we do have to remember is that an insurance transaction or a risk transfer transaction only happens after a long process of risk management. Before that, it's kind of the last thing that happens. Before you make any risk transfer or insurance commitment, you have to, identify and analyze your risks. You need to understand them. And I think there's a lot more we can do with people that, countries at the sovereign, sub-sovereign, or city level to help them understand those risks. And that's about giving them sovereignty and ownership of their risks. And that's really important because, particularly in emerging and developing economies in the global south and so on, sovereignty and ownership of their own things is really important. And we can support them. We're not there to solve their problems. We can help them and we can learn from them as well. It's a two-way thing. But they need to, by sharing data, by sharing insights, they can understand their risks better. And by having ownership of them, they can decide what they want to do with them. And when it comes to that final decision, sitting with an underwriter or an underwriting entity, whether it be a private sector entity or a multilateral or whomever, those sovereigns and sub-sovereigns become informed buyers and informed purchasers. And that's where they will see the value of the risk transfer at the end of the day. So whilst price signals are difficult to give, they will get them by understanding and owning their own risk and having sovereignty over that. And also the underwriters, it comes a point of, will we insure you at all? If you haven't done those steps beforehand, haven't taken ownership of your risk, don't understand it, haven't done the analysis, you might just not get coverage, right? No one will be prepared to do it. It got to a point where people wouldn't insure a wooden building without a sprinkler system, right? It's a very simple analogy, because we know, but we're not going to give necessarily a discount for having it. It just becomes a hygiene factor. You must have it, or else you won't get that sort of coverage.
And do you think that education piece is taking place in the market? Do you think that policyholders are becoming aware of, obviously we read in the press about the insurance protection gap and certain carriers pulling out of certain states in the US, for example. We obviously had the real heatwave crisis in Europe over the summer. As a buyer of insurance, do you think some of those policyholders are aware of some of the issues which insurers are facing, and actually how do we kind of breach that education gap so that what you're talking about in terms of having those good measures in place which will help them to procure insurance, they know about, and it becomes part of sort of business as usual for them?
Well, I think that is, we're not doing enough. We don't do enough as an industry generally on, educating or demonstrating the value. We're often criticized for, insurers don't pay out, but actually we pay out an awful lot of money, and we need to be demonstrating that, and not taking advantage of the bad things that happen, but just demonstrating the efficacy of what we do, and how we can help. Insurance is and risk transfer is a complex transaction. It's not simple. And no one likes to do it, right? I've been working in the insurance industry for over 20 years, close over 30 actually, and it's my heart still sinks when I have to renew my house and car insurance, right? Think about it if you're a minister of finance or a risk manager at a major corporation, or a chief resilience officer at a city. These are very complex financial transactions that they are undertaking. So we need to better educate, better demonstrate the efficacy of it. I worked with the UK government and we put on the Business of Resilience event for 2 years, which what was the Department of International Trade hosted. And actually, we brought together a lot of chief resilience officers from around the world, and the insurance industry and the multilaterals, to start building that community of knowledge and understanding of what can and should be done in this interaction between this large pool of capital that we have in the private sector insurance market, $3 trillion in the non-life insurance sector, and how we can work with the public sector entities to help them understand those risks and build resilience. And the last thing I'll do, we ran a program in East Africa, concentrated on Kenya and Ethiopia, where we ran a series of workshops and ideation workshops to working with, I think we had over 9 different government ministries represented, and talking about how they can use insurance to deliver the sustainable development goals. And of course, building resilient communities is one of those sustainable development goals. And, the lights went on with many of these people in the civil service, which just had no idea that this was even possible. So we need to be doing more outreach and more engagement in those parts of the world.
That sounds really positive. Michael, I'm conscious that we've got a longer session now, but I'm conscious you've got to drop off soon, unfortunately. So I just quickly wanted to turn to you before we do that, and after that we'll do the survey results. But is there anything else that you really wanted to add to the conversation, at this stage, having had the discussions that we've just had?
Yeah, I think I'd chime in again on the piece around where do we value or credit the role of prevention, and where in the process is there the challenge? Because if I'm honest and play devil's advocate, I feel there is a bit of a disconnect between what we as an insurance industry sometimes say at the highest level in terms of how we contribute to the protection gap or the closure of the protection gap. And that one of the key principles is risk reflective pricing. So this is something that we say very, very often, right? We price risks according to the level of risk, and that sends the right signals for customers or for society to take action and reduce the risk. But if we're saying that, I think inherently that also means if society does act and does reduce the risk, then somehow we need to follow suit and provide something that is in line with that new level of risk to be, again, in line with the principle of risk reflective pricing. So the question is, where are we stuck on that? And I really wanted to follow up on the sprinkler example, because my understanding of the insurance history is that this is precisely a good example, because in many areas of the markets, sprinkler premises get quite large discounts, I think up to 50% discounts on their fire insurance. And how did we get there? Well, I think we were technologically really involved knee deep in the development and the assessment and the understanding of the risks and the benefits of the protection to that risk, so that we could really then underwrite it and, actuarially better understand the pricing implications of that through certification, through research and development. I think the keyword there is underwriting laboratory. So essentially bringing an industry-wide knowledge institute to the table to help us analyze what is a good risk, what is a bad risk, and what are the pathways to get from a good risk to a bad risk. And honestly, I think the climate risk debate within the insurance industry compared to the fire sprinkler history is still emergent. So probably we are still on that steep learning curve where we need to better understand how it actually works. What is good protection? How do we certify it? How do we standardize it? And then how do we bring it into our underwriting models or our actuarial calculations? So I think that's where I see the opportunity to make progress and say, let's come to the table with more research, with more acknowledgement that once we understand those adaptation measures better, then also for our standard processes, for our, key, and I'm thinking corporate all the way to private line customers. So maybe not the specialty lines where we can do that more hand-on-hand, step-by-step analysis. But, really the mass market, here's a large property, here's a flood risk. We understand that currently we make a recommendation how to reduce that risk. And we have then the means to assess the new level of risk and better price it. And that doesn't just mean better, lower premiums. Maybe it means just more capacity. Maybe it means improved services, so you can go even to the next level. Or it could mean other aspects of line setting, lower deductibles, whatever it is. But I think we need to lend a hand and say, if society is reducing risk, yes, it has an influence on how insurance is then offering their services and their conditions.
I think there's a really positive message there in terms of that collaboration piece across the market, which I think we probably all agree from a climate perspective is so very important, that nobody alone can sort of solve these issues. It's around getting people around the table. And, you know, Julian, as you say, that the benefits that you've seen when you actually start having these discussions. So thank you, Michael. I think it's really, really positive, and we'll let you go on to your meeting. So thank you for your participation. I'll just update briefly, everyone. We obviously had a poll results, and the question was, what is the biggest challenge in building resilience and adaptation into mainstream insurance? So your response is short-term investment versus long-term benefits. So I think that's something we've discussed, 20%. Lack of reliable data, 10%. Coordinating action across siloed organizations, 10%, and the biggest by quite some margin at 60% is incentivizing whilst maintaining profits. And I think, you know, we'd all agree that is the biggest challenge that we're facing here. But hopefully some of the comments that we've made, sort of even the last of 10-15 minutes, will give ideas as to actually how to make progress on that front while still maintaining profits. So I'll just pick up on one of the responses then, which was lack of reliable data, 10%. You know, that's, you know, quite a low figure, and that could be ranked against the other responses there. But Antoine, just turning to you, do you think data has a role to play here? How do you think data could perhaps assist with some of the challenges which are being faced?
Yeah, thanks, Michelle. Absolutely. I think it's probably a common thread to most of the sort of responses in a way. You need data and analytics to make the connection between long-term and short-term investments. You need sound, reliable data to support decision makers and make the case for, you know, returns on investments and profit margins for specific government subsidies or sort of donors incentives into some of these programs. So I think it's everywhere and nowhere at the same time. I'll use probably two examples. One is the need to connect the dots between adaptation and resilience, short-term and long-term, insurance versus risk reduction. I think both of these sides of the equation have advanced modeling capabilities, but there aren't many frameworks or even, I would say, international experience on connecting these two sides of the equation. So I'll give you an example. You're the government of, say, Pakistan, Bangladesh, Ghana, Morocco, badly affected by climate change, barely sustainable economies, business models. So you're benefiting, let's say, from $1 billion from the loss and damage fund, for instance. How much do you channel towards risk reduction and how much for insurance, you know, subsidies? 90%, 10%, 95, 5, 70, 30. So there are currently very limited tools, frameworks, best practices to inform on that, because you're comparing really apples and pears. You're comparing short-term, long-term. And it's very difficult for decision makers. And I'm sort of parking aside all of these sort of governance issues and silos that we talked about. It's very difficult for decision maker to arbitrage between these different levers that they have at their disposal. So I think there's a lot that we can do, that the risk industry can do to help connect the dots. And I know that many broking firms in particular have started investing significantly into supporting their clients along those lines. I think a lot more can be done. It's tricky. There's a lot of uncertainty. And that's my second example or point. When it comes to digging into, you know, the nitty-gritty of assessing, let's say, a project return on investment, the role of sound, reliable data and analytics becomes critical. It's really, really important to understand at project level when you're building a dike, when you're sort of investing into sort of future climate scenario resistant crop types. You really want to understand at project level what's the implication on the tail of the distribution of your investment, because you're talking massive investments from, let's say, the Ministry of Agriculture. And currently, these these insights into return, impact, come with a lot of uncertainty. So as I said, I think data and analytics is everywhere, but it's nowhere at the same time. It's kind of the underlying ingredient to making the connection. I would just like to mention, because I saw that on the poll results, the incentives came up very strongly. I would just like to probably stress the sort of the effort and the investments of institutional donors and development partners into analytics in particular. You are, I'm sure you're familiar with the Global Index initiative, the sort of Global Risk Financing Facility, and now turned into sort of this Global Shield facility. So there's tons of investments. You're talking, $400 million plus of investments into, let's say, closing the protection gap with premium financing and more analytics in particular. And I think we'll want to make sure that this is connected with the loss and damage fund as a community, because that damage fund comes with more scale and is more sort of on the spotlight in terms of awareness of the need to invest into climate adaptation. It would be fantastic to connect the two. And I think analytics has a key role to play there in that connection.
That's very interesting. Thank you. Just a reminder to do send any questions in now, and then we can deal with them at the end of the session. But Julian, just picking up on what Antoine was saying there, he was talking about the loss and damage fund. Obviously, COP is just around the corner, where we know that this is going to be a big topic. Do you have any insights or thoughts really on how this is going to be addressed next month now?
Yeah, well, COP is looming large on the horizon, and the two things I'm personally looking out for at COP are, firstly, progress on the loss and damage fund, and secondly, on Article 6. Just, Article 6 briefly is the mechanism and framework for international emissions trading, carbon trading, etc. We're keen to see the rule book coming out on that, or more details on the mechanisms, Article 6.2, 6.4, etc. But loss and damage, that's the real political issue that is slowing progress on the broader progress on climate as well, because we have this political tension or between negotiating parties of, to very oversimplify, the developed economies have used up the carbon budget fundamentally, and we've been exporting this dream of, everyone should have 2 cars and a TV and a fridge, etc., etc. And now we're suddenly saying, oh, actually, you sort of can't. And as I said earlier, that genie is out of the bottle on climate change, and people are suffering the impacts of it now. So we have to create, ensure that they are protected from losses and damages that actually occur. And this is what, as an insurance industry, we've been doing for 300 years. And so we need to be part in contributing to that conversation, because we can and we should be helping to diffuse, because we have the technology, we have the skills, we have the data, we have the products and some of the solutions to solve the loss and damage debate. And if we are able to do that, that will unlock a lot more progress in other areas, because it is a huge source of tension. Because it's already happening. And people need to know that they are going to be protected from the events that happen. On the developed economy side, the big word that is the R word no one wants to use. It's that sort of reparations, and we just know that it's off the table politically, and so, but we do and must need to support events where they do occur and help people be resilient, help communities in their resilience and their ability to bounce back from these effects that the developed economy is contributed to.
But I think that comment you just made there actually picks up nicely one of the questions that I've seen just come through, which, you know, people saying, well, in the absence of, you know, data on the long-term cost benefits of investing in resilience and adaptation, you know, what tips do you have essentially for framing conversations with senior management, with chief underwriting officers on this area? You know, what are those wins to buy in these strategies? Because there is obviously a big concern that there are these big risk issues. We've talked about the challenges in identifying them. We've talked about how to build resilience to try and avoid some of these losses. But the issue of profitability, as we can see from the survey, kind of sits above all of this as a sort of slight elephant in the room, really. So, you know, do you have any tips on, you know, how to have those conversations, how to frame them such that it really is in the benefit of organizations to start focusing on these areas?
Yeah, I'll go back to the point I made earlier about owning your own risks, right? And doing all that pre-work to really identify and understand and analyze the risks. Because it's only when you really understand your risk can you make a valid decision of whether it's worth transferring or not. Not all risk can and should be transferred. It's, you know, insurance and risk transfer is there to deal with the risks that are going to really significantly impact your personal balance sheet, your corporate balance sheet, or your country's balance sheet. And, you know, I haven't been in the insurance industry, both on the underwriting and broking side, which is fundamentally you're an insurance salesperson, not what I intended to be, but it's, you know, you don't want to be having to do a hard sell. You want to have people who are informed buyers, who understand their risks and are keen and recognize the value. We can help them in understanding that and doing that analysis, but you know, and that expression informed buyer is really important. It's a completely different conversation you can have as an underwriter with a client if they really understand their risks and are really, because then they're motivated to buy because they know what they're buying, that we don't have to sell to them. And there is plenty of data out there about the long-term cost benefits of investing in resilience and adaptation. I don't think there's a shortage of that personally. There can always be more, but I think it's a well-established benefit.
Interesting. And another question's just come through now, which is about the role of parametrics and the extent to which we see parametrics as complementary or disruptive to traditional insurance. Can I direct that to you, Antoine? Do you have any thoughts there?
Sure, thanks, Michelle. Maybe just to add to the previous question on, just to complement what Julian was talking about, which I fully agree with. I think there has been very strong evidence based on recent sort of disruptive events. If you look at COVID, if you look at the Ukrainian war, these massively disruptive events have had consequences on everyone's P&Ls. So there is evidence, because I agree, I think the case is still quite difficult to make when it comes of quantifying the returns for your specific balance sheet. You might not, be able to model the risk of a future extreme events on your P&L, or the impact of risk reduction investments on your assets or liabilities. But there is strong evidence from recent events, particularly if you look at COVID, that sort of illustrate how extreme events, future climate risks, for instance, can make their way to your asset or liability exposures. So I would really encourage, I think, the community to go towards scenario-based risk assessments as a good sort of climate stress test framework and sort of strong evidence for your management. Back to your question, Michelle, absolutely, parametrics has a key role to play because it's sort of leveraging the wealth of data, particularly future sort of climate science and risk environments. We are much more, we as the community, the parametrics community, is a lot better equipped to price risk and sort of try and offer an alternative approach to the traditional market cycles and reliance on traditional capital providers. So I think it's becoming a very strong alternative analytical view on risk, a very strong alternative sort of capital provider base. So to us, it's a necessary now option that we have to put on the table to large, sophisticated public or private sector clients. It's becoming a no-brainer and an obvious alternative option to sort of traditional risk transfer. I'll probably use one example: the government of Egypt now looking at parametric products for not just earthquake but potentially flood risk financing. Even though you might think, there isn't that much data available, the exposure is poorly understood, there are no commercial model vendors offering models in Egypt, there is plenty of data that's openly available. There is plenty of census data when it comes to understanding the impact on, let's say, residential properties. So you can still do a lot with available data, even in supposedly data poor, quote unquote, environments. And that's where we think parametrics can be powerful, because it's focusing on data-driven sort of analytics and pricing. And second, because of the timeliness of the payouts, it's really sort of well suited to finance very timely, very time-sensitive expenses following a disaster, typically emergency relief costs, which are the main priority of, let's say, public sector clients in developing countries, because there's only so much fiscal space and sort of premium budget. So they have to target, let's say, the 10 or 15% of total economic cost emergency relief response that are most sort of time critical.
So it sounds like parametrics is increasing in terms of demand from clients. But in terms of the provision of that type of solution, sort of similar in a way to kind of micro insurance, do you see those types of products, and Julian, feel free to jump in as well. Do you see those products as the domain of specialists, or should all insurers essentially be looking to develop parametric and micro solutions in a kind of joined up approach?
Absolutely. No, thanks for that question. It's expanding. The parametric market is expanding massively. There are no clearly reported numbers. It's not a clearly reported line of business. But I think the consensus is around, let's say, $1 billion annual written premium-ish. There are plenty of sort of established market participants. It used to be, the remit of a few sort of insurtech and geeky underwriters up until maybe, 10 years ago. Things have drastically changed. And I was myself attending the Weather and Risk Management Association conference, the sort of European parametric conference in Munich last week. And there's so much more energy and experience and lessons learned from some of these companies. I think what's probably lacking is a strong offering around flood risk. That's the difficult one to crack. And that's where the demand is obviously more important. But on everything else, wind, drought, even hail or convective storm, there are models. Depending on the territory, there are very strong models, and basis risk is now much better understood. There are big sort of frustrations and challenges still when it comes to understanding the offer and the value for money you're getting. But I think the community has made a lot of progress massively. And so that's why many traditional players have now their established sort of parametrics teams that work alongside, let's say, their more traditional teams.
Interesting. I'm conscious we're nearly up on time, so if there's any last minute questions, do send them in. But in the meantime, I'll just ask Antoine and Julian just to give us your closing thoughts really on this session.
Well, let me just comment on the sort of parametrics microinsurance thing. As Antoine said, I fully support that. Anything we can do to simplify our product. I talked about insurance being a complex financial transaction, and it is, particularly in traditional indemnity basis. And parametrics is a great way to simplify it, and it has a certain elegance and speed to settlement, and no quibble of settlement. Get all that out of the way, it's really an important development. Microinsurance, I've been sort of a little bit unconvinced about. Talking to the Minister of Finance in Kenya, he said, I've seen so many pilots, I just want one of these to fly. And there are some really good microinsurance schemes going around where the insurance is embedded in a transaction, whether it's you buy some seed and the insurance travels with it. But I think we're going to have much more success at the parametric end of the chain rather than the microinsurance end. That doesn't mean there's no role for microinsurance. But my closing statement would really be, there are lots of these pilots. And some great demonstration transactions, and I know Antoine's been involved in the recent Moroccan one for the earthquake risk. But we need to scale this up, and we get some nice headline transactions, half a dozen a year, and they're really interesting and quite cool. But it's not enough to have half a dozen. We need 1,000 or 10,000 of those transactions. The insurance industry is here and it's open for business and can help. But we need that partnership with the multilateral development finance institutions. We need the sovereigns and sub-sovereigns to engage with us. And we really need to scale this up significantly if we're to contribute to the solution, and if the potential beneficiaries are to capture the benefits that we can offer.
I think that's important, but I think, it's picking up on a question that come through now. I think there is also, as we've talked about, an education piece here. And obviously everyone on this panel are really experts in the field. But I think as a market, we also need to, as the question says, what practical steps do we have for underwriters? How do you make sustainability a normal part of the underwriting process as well, across different lines of business? So I think that is something that we obviously also need to think about. Antoine, I'm conscious we've got about 60 seconds. So if you've got any final closing thoughts before we finish, that would be fantastic.
Thank you so much. Fully agreed with what Julian was saying. Fully agree that we need more scale. And that's what we brokers, I think, are working on, connecting the dots, educating buyers. And specifically, I'll mention two things in my closing remarks. One is the global shield. So we can probably expect 3 or 4 times as much premium financing to make its way towards, let's say, public sector clients in developing countries in the next 3 to 5 years. So we'll see more of the Moroccan, examples, hopefully with success stories and hopefully not many claims. But there will be more premium financing. So we, as a matter of fact, are already working with donors and development partners. I'll be in Ethiopia in 2 weeks to finally try to crack Ethiopia sort of macro sovereign schemes and connecting them with donors, because I think the education process is also helping these clients access funding, access the supply and then sort of market capacity. But we are there to connect them across all of these different stakeholders: donors, development partners, implementation partners, capital markets and reinsurance markets. So it's the full 360 that I think we as a community should do. And the second thought is on...
Sorry, I think our time is up, unfortunately. I think we're about to be closed off. But
I just want to say that it's a very safe investment. So if the community can invest more time, I think in 5 years' time, 10 years' time, it will be worth it.
Fantastic. Well, thank you to the speakers, and I hope you enjoy the rest of the afternoon. So thanks very much.
Thank you, Michelle. Thanks, Anthony.
I think the next panel already started. So fantastic.
Okay, are we good to go?
Everyone.
Thanks,
yeah,
brilliant. Good. Well,
so
well chaired, Michelle. Antoine, I'd love to catch up with you. Well, and Michelle as well. I'd love to catch up with you separately. There's clearly lots to talk about.
Absolutely.
Fantastic. Nice to
Good.
see you both.
Good to
Bye
see
then.
Thanks. Bye.